Once again, thank you for many, many forms of welcome to Professor Shalnieres, Mr. Baweja, and Professor Pani for an extremely kind and generous introduction. It's always a pleasure to be back in Mysore. As was pointed out, I did all my schooling here. I went to Nirmala Convent and then went to Mahajana's College for my PUC. After which I went to Delhi for my, at that point I had no knowledge of economics. I don't know the E of economics, hadn't taken a single class in it. Went to Delhi and did my first course in economics from Lady Shri Ram College and then Delhi School of Economics, and then I've ended up where I am. But anyway, and the reason I'm telling you this is to tell you that, you never know where life will take you. And the only thing I know that works is constant hard work, and if you keep doing that, with some luck, you can get to where you want to be. So today I'm going to, the topic I chose to speak about is on global economic trends and implications for India. The reason I did that is because I think we are coming out of a very interesting phase. As you all know, the global economy was hit by one of the biggest crises since the Great Depression in 2008. And now we're 7 years out, and we see signs of recovery. So we see the world economy repairing itself, so it's a good point to pause and look ahead to see where we think the world is going. So that's kind of what I'm going to do. I hate making predictions, so I'm not going to do that. But I think there are certain kinds of trends that are well established at this point and will play out in the next several years. And so it's important to think about what that means for the world, and especially what that means for India. So let me just give you some facts, firstly, in terms of the growth rates around the world, how economies are doing. If you take a snapshot now and you want to think about different parts of the world, there are multiple tracks. Countries are growing at very different growth rates. So if I look at the advanced economies of the world, it looks like they've bottomed out in terms of their slowdown, and most of them are recovering. But at the same time, they're all not recovering the same way. So if you take the US and the UK, the United States and the United Kingdom, they are predicted to grow at around between 2 and 3%, maybe closer to 3% over the next year and couple of years. On the other hand, if you look at the euro area, their prospects are a little worse in the sense that they might grow between 1 and 2%. And then if you look at Japan, that's probably the weakest part in the advanced economy, where the growth will probably top out at about 1%. Right? So there are these three tracks of growth even within the advanced world. The other phenomenon that we witness now is that growth rates in the emerging market world has slowed down. So this is different, because if you look at the years right after the crises, you had advanced economies slowing dramatically, and you had emerging markets basically led by China that were growing very fast. And now things have reversed some, where the advanced economies are growing, and you've had a slowdown in the growth of the emerging market world. So if you look at the rates, if you look at around 2010, emerging markets as a group was growing by around 7.5%, and now emerging markets as a group are growing at 4%. So that's a dramatic slowdown. And again, this is because of China's slowdown, but now you see it across the board in Brazil and South Africa. So India is actually an exception here in terms of its growth rate. It actually is one of the countries that are actually doing quite well. Now, if I go past 2 years and I say, well, I'm not purely interested in the very short run, but 3-4 years from now, we should expect that to reverse. So we should expect advanced economies to continue their growth at around 2%, but then we should expect emerging markets to come back up, because that's where the potential is, that's where the growth potential is, and you're not going to see 6, 7, 8% growth in the US ever. but you're very likely to see it in India and very likely to see it in other developing countries. So that should reverse. So let's now, once we know kind of the way the world looks in terms of its growth rate, let's look at what I'm going to define as economic trends, important economic trends going forward. So in my opinion, there are 4 global economic trends that will affect the world. Okay? So the first is China's slowing growth. Okay? The second is the collapse in commodity prices. That's happened recently, and we have to see how quickly that it recovers. The third is the beginning of the end of easy money coming out of the US Federal Reserve. As you know, recently in the December 16th meeting, the US Fed, for the first time after a period of almost 10 years, raised its interest rates from its absolute bottom close pretty much 0% rate. They raised their interest rates for the first time by about 25 basis points, which is 0.25%. So it's good to pause and think about what the implications are for the world economy. And then the last trend is a more long-term trend, is the fact that there is a reason to be concerned about inherent weaknesses in the advanced economies. And one source of those weaknesses come from demographics. That comes from the fact that these advanced economies have aging populations, especially Germany and Japan have aging populations, and that has implications for growth rates in these economies. The other advanced economy problem is that if you look at productivity growth, that has come to real standstill in these markets. And the other issue with weaknesses in advanced economies is what's going to happen to the euro area. I think that's a question that we still have to wait out and see. I mean, there were many times in the past couple of years when we thought that the euro program, the whole euro zone would fall apart, and that didn't happen. But we still have important questions coming up, which is UK's decision about leaving the euro area, issues of migration within the euro area. These are all big challenges that are being posed, and we have to see where that plays out. So let me just quickly go into each one of them. So China. So the first was China's slowing growth. So China, as we know, in the past 3 decades, basically grew at close to double-digit, on average double-digit rates, and became the second, depending upon whether you use the PPV-based measure or the dollar-based, the exchange rate, market-based exchange rate measure, is either number 1 or number 2 world economy in the world. And how did it grow? It grew heavily through investment, physical infrastructure, capacity creation investment, and through exports. Those were the two engines of growth for the Chinese economy, was building things and exporting things to the rest of the world, basically becoming the manufacturers to the rest of the world. And now, for natural reasons, some reasons which I would define as natural, which is the fact that the economy has now matured to a point where they built up a whole lot of capacity, and at this point you could even argue that they have excess capacity. And because of the levels of income going up in China, with wages having risen, they've lost some of their competitive advantage in manufacturing. And because the world economy was slowed down in these last 7-8 years, the demand from the rest of the world for their products has also come down. So for these reasons, it's important for the Chinese economy to move towards its focus on investment and export-led growth towards domestic consumption-led growth, which is kind of what typically happens, right? So through spending, through consumer spending in China, through spending on the services in China, so that's kind of the switch that's happening, moving away from manufacturing towards the services sector. So if you look at the sectors that have slowed down a lot in China, it's basically industrial sectors, mining and manufacturing. The sectors that are growing are the services sector, the internet services, healthcare, education, those things are growing by a lot. And China is going through the switch. Now the problem is that there are important weaknesses in the Chinese economy. And there is a concern that this transition from double digit to 6%, which is 6-7%, while so far has happened fairly gradually, might then be very dramatic for another couple of years. And the couple of big concerns is that China has had a major credit boom, right, which has had a huge amount of credit expansion in their economy over the last 5-6 years. And what we do know from all the research that we've done about leading indicators of crises, the credit boom is like one of the #1 leading indicators of crises in the country. The other problem is that most of this lending has been done by the shadow banking sector, which is the unregulated sector. And there's also a lot of lending done by the state banks. And so the question is how all of this will play out. So I don't know if you paid attention that about a couple of months ago, the Chinese government decided to devalue the yuan by about 4%. Okay? And it had big impact on world markets. I mean, there were, even the U.S. stock market reacted very strongly, but across the board, all stock markets did. Now, if we pause and think about it, a 4% devaluation in terms of actual economics of the impact on the Chinese economy or on the rest of the world is absolutely tiny. It doesn't mean anything. But the problem was that because the data coming out of China is usually people are not very sure about the numbers that are reported, that whenever they see anything that looks like a sign of weakness, which this particular devaluation was interpreted as, then it's a signal that the Chinese economy is actually weaker than you think. And so the sense, this uncertainty related to the Chinese economy is really tremendous. And why does that matter for China, or for the rest of the world, that China is going to slow down? Because China is huge on the world markets. It makes up about 10% of the world's imports, world import demand. Demand for imports comes from China. Right? It's importing 10% of the world's imports is Chinese imports, which is big. So if you are a producer that's selling to the Chinese market and the Chinese economy starts slowing down, you have very good reason to worry. The second thing, which will lead into my commodity prices argument, is that they've been a huge, because they've focused on this, on investment-led growth and building and capacity creation. They relied heavily on demand. They had huge levels of demand for fuel, for industrial supplies like metals, for capital goods, and those are the sectors. Those are where you had the biggest collapse in demand coming out of China. So that leads me into the second big issue that the world grapples with, and that's commodity prices. What's happening with commodity prices? The commodity prices are historically known to be very volatile. There are periods when they go up very dramatically, periods when they come down very dramatically. But what we see now is that over the last about half a year, maybe a year at this point, commodity prices have fallen by 40%. Okay? So that's a huge drop. That's a huge drop. And that drop has come about because of two reasons. One, because of China slowing down, the demand coming out of China has gone down, and China was a big buyer of this. So in fact, China was responsible for half of the world demand for metal. That's 50% of the world demand for metal. I mean, that's huge. It's a big player. So that was an important factor. The second is a supply side story, which is you had the whole shale gas revolution in the US. And the third is the fact that the Middle East has decided. So usually when there's a collapse in commodity prices, the OPEC, the Organization for Petroleum Exporting Countries, which is headed by Saudi Arabia, usually goes and cuts production because they want to stabilize the price. But they decided not to do it this time, not for political argument, but for pure economic arguments, which was basically to kill less productive manufacturers, to kill a lot of their competition. And that's what they wanted to do. So they said, well, there's a whole lot of you who can be perfectly viable when the price of oil is $100 a barrel, but are completely unviable when you're at $50 a barrel. So we're going to keep the prices at that. We're going to let prices stay at that level, and we're going to shake out the market, and then those of us who can produce it and stay profitable at $20 a barrel, those are the ones that are going to survive. So that's the second big major trend that you see. And if you look at projections in terms of where you think commodity prices are going to be, the IMF came up with its projections for 2016 and showed that those commodity prices are not going to recover much. There's going to be some recovery, but not by much at all. I mean, that's the projection going forward. So that's the second major trend. The third big trend is the beginning of the end of easy money, which is the tightening of interest rates. Now, I don't want to exaggerate this because while the US has raised interest rates, it's going to do so at a very slow pace. It's going to increase it only by 25 basis points, so it's not a big deal in terms of the numbers. And you still have Japan and the euro area that continue to have an easy money policy, which is keep interest rates very low. But it still is a big deal because what we've seen, so in the last 5 years, we've had a very interesting phenomenon happen. When interest rates, with the US having all its many rounds of quantitative easing that I'm not going to get into the technical discussion about, the cost of borrowing came down by a lot. And you've seen debt build up, which is you've seen heavy amount of borrowing. But that heavy amount of borrowing has not happened in the US. It's not happened by US households, it's not happened by US corporations. That build up has happened in emerging markets. It's happened by corporations in emerging markets that have borrowed heavily in dollar terms at these extremely low interest rates. Right? That's a brand new phenomenon because in the past too, when interest rates were low in the US, it used to be the case that a lot of capital went to emerging markets. But a lot of that, pretty much all of that, was basically borrowing by the governments. And if it went to the private sector, it was intermediated through the banking sectors in these countries. But this time around, this debt is not on the balance sheet of banks, it's not on the balance sheets of banks, but it's on the balance sheets of emerging market corporations. And the biggest problem is that these emerging market corporations, some of them were major commodity exporters. So they're going to get hit both ways, which is that they have the commodity prices collapse, and they have now, with interest rates going up, their cost of borrowing goes up, their cost of rolling over their debt goes up. And that's going to cause, that's a major concern that's been flagged by many multilateral institutions, including the Bank of International Settlements. So that's another big trend that we've seen. And basically what corporations have done is that these are big corporations in emerging markets that have used their US subsidiaries to basically borrow in US dollar terms. Then that way they've taken the money back, transfer that money back to the parent in their home country. And then their home country parent lends the money to the banking sector in local currency terms. And then the banking sector pours that money back into the local economy. Okay, so this is a very new kind of intermediation, and there is a lot of reason to worry about where what will happen as U.S. interest rates start going back up to its previous level. Then the fourth major trend, which I mentioned, was the weakness in advanced economies. This is an aging world. According to the OECD, the world is going to continue to age over the next 40 years. So we are, as a planet, we are growing old. And that's a big concern. Why is that a big concern? Well, because if you look at expenditures by older generations as opposed to younger people, there's less demand that comes from them. So they're not big spenders. They're not the ones who are buying durable goods. They're not the ones who are building houses at the age of 70. So there's less demand coming from them. And so there's less growth that you might expect. The second thing is, if you want to think of entrepreneurial activity, most of the entrepreneurial activity, with the exception of my father, gets done when you're very young. And so if you look at statistics on entrepreneurial activity, it's very much the case that the older the population, the lesser the level of entrepreneurial activity. So as economies age, that's another major concern. And that has big implications at many levels. For instance, the US, it has big implications on the fiscal side, which is you're not getting much tax revenue from, because most of these people are not working. At the same time, you have Social Security, which means you're responsible for their old age in terms of pensions, in terms of healthcare services. So we have an explosion in the projected budget for the older generations. It's a problem in terms of monetary policy, because as the Fed is trying to raise interest rates, they want to figure out what's the natural level of growth of the economy. And if you have aging demographics, that takes away from growth rates. And so previously, the Fed would raise interest rates, 4% was considered normal. But now the sense is that maybe 2 or at most 3% would be considered normal interest rates. Okay. The second is the slow TFP growth around the world. For some reason, productivity has slowed down. In fact, investment has also slowed down in most parts of the world, and that's a big concern. And then the euro challenges. The euro challenges are many. You have, they are still growing at a very anemic rate, including the big countries' economies like Germany, less than 1%. They still have issues with heavily indebted corporations and banks with bad assets. That's also a big problem for them. But of course now I think the existential threat is also coming. And the existential threat is about with the concerns about immigration and with the concerns about migrants, there's a lot of hostility being built up against the migrants. And if they go back on their policy of letting free flow of people across their borders, then that's like the beginning of the end of the Euro project. And unfortunately, if you look at certain political developments in Europe, like what happened in France recently with Marine Le Pen winning certain elections, there is clearly a sense that in a lot of the richer parts of the Euro area, they are quite fed up with immigration, and they're quite fed up with bailing out Greece, and these big concerns are popping up. Okay, so that's my take on the big trends that I think of for the world. Another question is, what are the implications for India? Right? So these 4 trends, what does this mean for India? What do we need to start thinking about going forward? What do we need to do to bring our growth rates up? And does it matter that these global trends are in play? So there's a lot of, I would say, good news for India. I mean, these are challenges that I put up there in terms of issues for the world economy. So the first is the commodity prices. In terms of commodity prices, India is a net importer of commodity fuel, raw fuel, and of course it does a lot of processing and exports that out. But it's a big commodity importer. And so this is a big plus for India on net. I mean, there are always in economics, there are winners and losers, and the question is, there's always a trade-off, and the net is what we care about. And the net, on net, India actually is in a rather privileged situation, one of those few emerging markets that are in a situation where the commodity price fall is on net a positive for India. That is not true for most of the emerging markets. So if you look at Brazil, South Africa, these guys rely very, very heavily on revenues from commodity exports, and they're struggling a lot. They've had very steep slowdowns in their economies, big collapses in the value of their currencies, and weaknesses overall. And basically, Brazil is basically in a recession at this point. And so that's a major concern for these markets. There are also advanced economies that are affected by the commodity price slowdown. So if you look at Australia, this is a big negative event for them. They're major commodity exporters, and this has had a bad effect. But there are much more diversified economies than Brazil or South Africa or Saudi Arabia or Russia, for that matter. Russia also is tremendously hit by this. So if you look at the BRICS nations, Brazil, Russia, India, China, and South Africa, if you take with the exception of India, all those other guys are exposed to this negative shock. The other shock about the slowdown of China and the fact that it might continue to slow down in the future is also not a major concern for India. If anything, it could be good news for India. And so why is that? So is China a big market for the Indian producers? It's not. So exports to China make up about 4% of India's exports. So it's not as if India relies very heavily on Chinese demand for its growth. So if the fact that Chinese economy slows down, that may not be a big concern. We do import more from China than we export to China, but that's fine because it tells you that China is going to look for sources of demand, and if we can buy their products, we should be in a position to bargain good prices too. Again, this is unique from the other nations in the BRICS, who, in the case of Brazil gets hit both ways. It's a commodity exporter and it's a big exporter to China. That's not true for all commodity exporters. So I could give the example of Colombia, that it's a big commodity exporter, but its destination is not China. But Brazil is hit both ways. Then South Africa is also hit both ways. Indonesia, Malaysia, Chile, Peru, they're all hit with their exposure both as commodity exporters and because their main destination is China. And then there are countries like Korea and Thailand that have value chain in China, which is basically that initially China used to produce everything that it exported domestically, but now what it's doing is that it's phasing out stages of the production across countries in Asia, especially East Asia. So economies like Korea and Thailand that have been exposed to, who rely on China being a big exporting juggernaut, that will continue. They're going to be hit by it because the demand from China is going to slow down. So that's Korea, that's Thailand, and that's going to be a problem. So 2 of the 4 global trends that I talked about, I said was not going to be a major concern for the Indian economy. If anything, India should step in. If it can build up its own capacities, it should be stepping into the world market and taking the place that China has. Now, while it's true that world trade has slowed down and all of that, but still, I mean, India's share in world exports is about 2%. So even if the world slows down, if India can bring its share up to 4 or 5%, that would be really great, and exactly what we should be aspiring to do. The third is Fed tightening, the raising of interest rates. Here again, India is the exception here among the emerging markets in the sense of corporation indebtedness. So I told you that one of the big problems is that there was a big increase in borrowing by emerging market corporations of doing dollar borrowing. India is one of the least among those. I mean, it has had some growth, but it's not anywhere near the growth that we've seen in Brazil or in Indonesia and Turkey. So those kinds of economies have had this big increase in borrowing in dollar terms. India is not one of those countries. But that said, the Indian economy is still very much exposed to global capital events, right? I mean, you can't escape. As long as you have an open capital account, you're letting capital come in and out. Any kind of uncertainty about the economy, the way the world economy is headed, there's an immediate panic effect, and investors pull money out of emerging markets and take them back to the developed world. So in fact, in recent time, you've had a big pull out of investment by institutional investors in the US, have pulled out of the Indian market in the last 6 months. Foreign direct investment has come in a big way into India, so that's a good sign, that's a positive sign. So even though India is doesn't have this big concern, it's not going to show up in any of these reports as being a problem for their dollar debt. It is something that Dr. Rajan and the RBI will still have to worry about. And so that will stay. So among the 3 that I put there, I would say commodity prices going down is, if anything, a plus for India. China slowing down is not such a big deal. Fed tightening, raising rates, maybe a little more worrisome, but again, in the group of emerging markets, not such a big deal. And then the third is world demand. Now, it's always a problem when world demand is slowing down. This is the weakness in advanced economies. Any kind of turbulence in the euro area is going to affect India. It's not relied very heavily on export-led growth, but that there has been a big increase in exports from India over the last 10 years. And so the slowing down in world demand has certainly affected India's growth prospects. Okay, so what then do I think are the problems for India? Right? So I mean, I gave you the big global trends, and in terms of demographics, India and South Africa are the two nations that are getting younger over the next several years. Right? It is. You had a huge demographic dividend in India. You've heard that phrase before. You're going to have very large numbers of people of working age. So in terms of demographics, that's a big plus. While the rest of the world is worrying about aging populations, that's not a concern for India. It will be a concern from 30 years from now, but nobody's thinking that far ahead. But this is a big plus. So in terms of global trends, like I told you, it seems like everything is, it's true that there are some concerns. These are much smaller magnitude than most other countries have to worry about. So when I hear statements coming out of bureaucrats in India or ministers in India when they say that, oh, our growth is a problem, but the reason is because the rest of the world is in trouble, I'm not so persuaded by that. That's not my opinion. I mean, that's just not an excuse. It's not like we're a big commodity exporter, we had a big collapse in our commodity prices. I mean, it is not that. So we are not so heavily reliant on the negative forces coming out of the world economy. So what is then, I'll just take another 5 minutes or so, 5-10 minutes, is the problem with the Indian economy. Okay, it's a difficult thing. We were all very excited about the prospect of having a government in power that would fix the problems of the economy, that would put an end to so-called policy paralysis. I was quite tired of coming to India. Everybody's throwing the word policy paralysis all the time. That was the Congress government. So we thought, oh, well, this will come in. There are all these fantastic projects out there that should undertake investment. Things should start up. All right. You look 16 months since the Modi government came to power, and there has not been a takeoff in domestic investment, in private sector investment. So again, to be very precise, I'm talking about investment by Indian corporations, which is the big driver of overall investment in India. That variable was very high in 2011. It was a high number, much lower than China, but it was a high number in 2011. It collapsed after that. Everybody blamed that on the policy paralysis and the fact that nobody was making decisions or projects couldn't be undertaken. But it's been 16 months since this government came to power, and that hasn't changed. If you see a graph of it, it's fairly flat. So do I think that this means that this government hasn't delivered? I wouldn't say that. I think that this government is pushing a lot of buttons, but the problem is that it is not fixing the issues that have slowed down private sector investment, right? And whenever it comes up, the thing is that, oh well, this is legacy. This is a problem that the previous government gave to us, and so oh God, we can't really deal with it right now. But this is the number one issue. So what do I think of as in my opinion, the 3 things that are a problem that is keeping investment weak in India? The first is that we have an interesting situation where Indian corporations, the people who really do most of the investment in India, they have very high levels of debt that came about because they started, a lot of them were in this PPP projects, public-private partnership projects in infrastructure. And at that time, there was a lot of optimism when India was growing briefly at even 11%. And we borrowed heavily, mostly from public sector banks, at very favorable rates. We invested money into these projects, and then everything came to a standstill with all the scams and all the problems. So the current government is correct. The problems that they have come from the previous government, and that's certainly true. So you have corporations with high levels of debt, and they don't want to invest. When you're sitting with very high levels of debt, you don't want to invest in other marginal repeat in the economy, unless you get clear some of this out. And the banks, the public sector banks that lend to these Indian corporations, are sitting with what they call so-called non-performing assets, right? With assets which they're not able to recover their money from. So again, I agree this is a legacy problem that came about, but the problem is now you're in charge, and you have to fix it, right? And also, there's also, I can understand that there is not a clear acknowledgement of the problem because it is actually a major problem. If you look at the numbers, non-performing assets are supposed to go at 17%, according to Credit Suisse, 17% of the total assets of the banking sector. That's a very large number. Usually a number like that would flag concerns of financial crisis. So that particular issue needs to be fixed. Fixing that will require some corporations to have to shut down. It will require some unpleasant haircuts for the lending from the state banks, which is basically saying that, okay, for every 100 rupees I lend to you, you give me back 50 rupees and we call it a deal, right? There are huge political problems with that because you can imagine, as you know, anytime something gets done like that, you're going to have everybody on your back into the Supreme Court. But that's how it gets resolved in the world. I mean, that's the only way it gets done. When both the banks and the corporations are suffering and they have a benefit from a renegotiation, the only way it works is if each side gives something, right? And so this particular action needs to be taken. Otherwise, you're going to need a big capital infusion into India's banking sector. And that's not going to be good at all for the economy. The second problem is that a lot of the reforms that one thought would happen, at least in the first year of the Modi government, have not happened. So the land reform bill, for instance, is something that they now, they tried. I don't think they tried very well. I don't think the bill was great. But they basically found out that they don't want to use their political capital for it. And so they've now decided to delegate it to the states and let the states decide. But in addition to the land bill, you also need bankruptcy reform. You also need the development of bond financing in India. That's a big problem. Bank corporations borrow heavily from banks as opposed to from by issuing bonds and having households and everybody else buy corporate bonds. That's a big problem for the Indian economy that needs to be fixed, and the RBI and the government has to do something about it. So those big reforms haven't happened, and as you can see, the political problems that this current government is facing are immense, and so it's going to be slow. The third factor is that the real cost of borrowing has gone up by a lot. So, the RBI kept rates very high for a long time because it wants to bring inflation down. Now they've had this fortuitous combination of commodity prices coming down, fiscal consolidation, and the tight interest rates were certainly helpful. So inflation has come down by a lot, but the nominal rates haven't come down as fast. And even though the RBI has cut rates by 125 basis points over the last 6-7 months, the banks are not passing that through to the borrowers. So right now it's very onerous. It's a very onerous rate at which, if you were a manufacturer or any other kind of borrower, to borrow at those rates. So that is a problem. Again, for that, I don't think that there are very easy solutions. The reason there aren't easy solutions is because on one hand, Dr. Rajan has his eye on the Indian rupee, on the value of the currency. The value of the currency is really affected a lot by capital flows coming in and out of it. He's worried that as the US raises interest rates, if now India starts cutting rates, maybe the rupee will devalue by even more. And so in the near term, I'm worried about this grid loan. But this is a problem that has to be fixed. Because we have numerous examples of economies, the biggest example being Japan, where for the longest time they refused to fix the problem, which is just let corporations sit with that debt, let banks sit with non-performing assets, and then they had lost 10 years of growth. And so that certainly needs to be addressed. But overall, from a world perspective, I should give credit to the Modi government in the sense of raising the attractiveness of India as an investment decision. For the first time, if you look at the World Bank's ease of doing business measure, it's actually improved, by about 12 points. And it continues to the World Economic Forum, gave it a big increase in terms of its competitiveness. So it's done very well. The thing is, It's going to be a slow process. I think we move towards even more fiscal federalism, where the state governments are going to do a lot more. And so it doesn't matter what the center thinks about policies. It ultimately is going to depend upon what the states implement. When investors, or foreign or domestic, go to a particular state, they ultimately have to deal with the bureaucrats of the state government, of wherever they're working, and that's an issue too. And so those have to be fixed. But anyway, I'm going to end now, and I don't want to end on a negative note. I want to end on a positive note, which is, again, like I said, the global economic trends that I listed out, while a concern for India, are nowhere near as big as a concern as they are for most other countries in the world. India is, in terms of its macro indicators, India is doing very well. There's obviously a lot of debate about what exactly is India's growth rate. But whenever anybody talks about emerging markets, they say emerging markets are in bad shape with the exception of India. So there's a lot to be proud about. There's a lot that one should be optimistic and look forward to. And I really do hope that we move towards, the next time I speak about global economic trends, I can talk about India transitioning to double-digit growth rates on a sustainable basis. Thank you. World is not going to be at 3 to 4%, but it's going to be at around 2%, which means then, for a country like India, for whom the US is an important export destination, that slower growth means that the growth rate of India's exports, assuming it doesn't diversify into other markets, is going to be a problem. But again, because I think India is so small in the world trade markets at this point, that it really should be thinking of increasing its share. So that's the potential negative concern. The potential positive thing that comes from, you have to be really careful with it, but one of the positives that comes from productivity growth being low is that we should expect the US Fed to keep interest rates at a low level for a very long period of time, because its target interest rate would be much lower. So in that sense, there might be more of an easier credit environment globally. But that could be a mixed blessing, but those are the issues I would get there.
Thank you.
Good afternoon, ma'am. Thanks for your insight. I have a question regarding India only. India is doing very well in terms of economy because of all this FDI and Make in India. But in terms of agriculture sector, India is still an agriculture-based country. The whole GDP, agriculture provides around 13% of GDP, and 15 to 60% of the population depends on agriculture. And you talked about the commodity price coming down, but in India it doesn't seem to be so, because if you talk about commodity, the pulses rates are around 200, the onion rates are around 80-90. So the commodity price which you are talking about in India, I don't think that it's working over here. And there is a lot of farmer suicide happening in almost every part of the country. Take Maharashtra, take Andhra, or take any state for example. So India is focusing on making India FDI and all, but it will take a lot of time to transform India from a agriculture-based country to industrial-based country. So what it is doing for the agriculture, and yesterday I studied one article which talked about the reason of pulses prices going up in India, and why the farmers are doing suicide. So the reason which the people mentioned was India depends a lot on imports for these pulses prices, and Indian agriculture and the rate on which it was importing was around 45 to 50 rupees, and Indian agricultures were not able to match this price. So they left farming the pulses, and then those countries raises the price, and so the whole prices of the pulses has gone up. So what is your take in this?
Okay, great. Thank you. So you're right, but I'm going to just correct the way you described the economy. I think you had it right, but I would not say that the Indian economy is agriculture-based. It is agriculture-based in terms of employment, in terms of the number of people employed in agriculture. But in terms of what contributes to GDP growth, is number one services.
That is all 30% in terms of agriculture, 30% of
Yes,
GDP.
yes, it's 13%, but services is over 50%.
But in terms of employment, it's 3%.
Yeah, but it's light right blinding me over here. I can't even see what you're saying. But let me just continue, and then you can step back. So in terms of value added, agriculture is not the major contributor to growth, but that doesn't mean that it shouldn't be. And that is certainly an area that requires a lot more attention. Now, you're right that agricultural productivity is very low in India, just the way agriculture gets done in terms of the size of the farms. That's extremely low. You mentioned about food price into the income of farmers. So there should be a way to get around that, and that certainly needs to be fixed. Now, I do think that as India grows, it will need to transition from having 60% of its population working in agriculture towards manufacturing and services, and that should happen, but of course that can't happen overnight. And until then that doesn't happen, we have unfortunate incidents in the agricultural sector.
Good afternoon, ma'am. Recently we've heard of this global currencies as an alternative, such as the bitcoins. So what is your take on that, and how would it be influencing the economies? Is it globally acceptable? Is it globally acceptable?
Right. So, I mean, as a way of easing transactions, I think most people are okay with it, including the U.S. Federal Reserve. The problem comes about when it becomes completely, the question is when you have to start worrying about regulating it. As long as people who are entering into those kinds of transactions and expect somebody to bail them out, then that can be a problem. And so the question is, I think the world is waiting to see at what stage you need to maybe go in and think about regulating that sector, which would, which is something that the big point people would not want any form of shape. But as a transaction technology, I think that's a perfectly reasonable, a perfectly good alternative.
I think you overemphasized the impact of commodity prices, particularly fall in crude prices on the Indian economy, because the government of India has passed on the very low crude prices to the general public. In fact, what matters is commodity prices like the price of cement and steel in India are still subject to cartel forces, and as a result, they have come in the way of boom in the construction sector with millions, which provides employment to millions of people. This is one aspect. And I would like to correct that the contribution of agriculture to India's GDP is around 15%. It employs 60% of the people. 15% is the contribution to the GDP.
Yeah.
That's why we have low income jobs under employed farmers and farmers committee, which you said. Secondly, I would like to know specifically from you, the recent, in the last 1 year, we have had a major policy departure. Planning Commission was abolished overnight. Instead, NITI Aayog has been formed.
Yeah.
And also, there is a slogan called Make in India. Whether these things, these initiatives of the government will bring in results. Thank you.
Great, thank you. Great. When I say it's good for the Indian economy, I'm thinking about from the fiscal budget side of the government, the fact that they're able to buy crude at much lower prices, but at the same time they're not really reducing the prices at the pump that much, and so there are revenues to be had from there. I was at this meeting with Arvind Subramaniam, and he said that one of the good things about not passing this decline through is that it's actually environment friendly. That's a problem in the developed world, that because they pass through all these price declines, consumption of fuel and buying highly fuel inefficient cars has gone up by a lot, and so that maybe the U.S. should also be like India, not pass through entirely the thing. But you're right about the fact that it hasn't been passed through. In terms of NITI Aayog and Make in India, so these are big changes that have happened. So again, Make in India, for me, I would start saying that Make in India is a success when I start seeing more capacity creation happening. So this is where I come back to this point about investment in India. and actually building infrastructure, building things. So things are taking off now. It's slow. Everything is, I think there's now recognition that things will move at a slower pace than anybody maybe initially thought 16 months ago. There are some sectors like defense in which maybe things move along faster. There's some areas like railways where maybe things move around a little faster. But we're not anywhere at the stage where we can say that Make in India looks like a success or that it's turning out to be a success, and we have to wait and see. And the Niti Aayog, Niti Aayog is consistent with this new trend of basically fiscal federalism, which has let the states make their own decisions. More the recent 14th Finance Commission gave a greater share of central revenue to the states. So that's. But a lot of the decisions are going to be made at the state level. A lot of the spending is going to be made at the state level. Niti Aayog is more of an advisory council at this point in time. We'll see. It's hard to measure exactly what its impact is.
Thank you for a very good macroeconomic view of the global economy. But as an eminent international macroeconomist, may I know your perspectives on the impact of increasing environmental concerns on the global economy?
The recent Paris talks were concluded. So, so if you step back and think of what exactly the Paris talks have come up with, I think the main thing it was successful in accomplishing was everybody had a sense that we must do something. Now, they put a lot of things on paper. They have targets. They have, that the advanced world is going to contribute 100 billion to help the developing economies enforce it. But there is no teeth to it. There is no, there is no system in place that what happens if some countries. Obama cannot promise anything at this point to any fund. The claim is that the U.S. would contribute $3 billion to this fund, but it has to go to Congress. It doesn't. We don't know that. Let me be clear. And so I think what came out of the Paris talk was that it seemed like the whole world at least was on the same page of saying that even if the rest of the world doesn't do anything, each of us independently should want to do something. So that's true about India too. When I met with the Environment Minister Javadekar recently and asked him about this thing about what happens if this $100 billion funding doesn't come, how will that change anything for India? And he said, no, we're already spending like 20 billion on our own. I don't think it's an issue. So in terms of, so this is going to be a slow process. This is not going to happen overnight. It's going to be a slow process. There's going to be alternative sectors like solar and other kinds of alternative energy that's going to get a lot of attention, waste management, other kinds of areas. And that will potentially create new kinds of jobs. The bigger concern is whether in the process of, we're going to do this slowly, but what happens when you have big mishaps in the world because of big climate events? Those are going to be very costly. This is kind of an interesting thing about economics, which is if you look at, China had a lot of costly devastation. Which means that if you look at China's state GDP growth rate, it's going to go up in a way because you're going to have to spend a lot to fix everything up. So we should expect to see a lot of investment in new kinds of technologies, but I would not read. The Paris Agreement doesn't tell me that there's going to be anything dramatically different from what countries were doing in the past.
What impact it will have on global markets? And my second question is, Indian government is about to launch GST bill and insolvency and bankruptcy bill.
Yeah.
How come investors got attracted to that bill, and how come it will have an impact on ease of doing business in India?
Currency B1, or the RMB, depending on how you call it, a global currency. And they won one major, I guess you could say, I would rather say it's a small victory, but in their opinion a big victory, which is they're now a part of the IMF's bundle of reserve currencies, which go into its unit account, the SDR. It's a very small share. It has a very small share of the reserve currency basket, so it's not really going to make much of a difference at all. What China has been doing is because they want to have their, they were very concerned about the fact that because they were engaged heavily in world trade and they were getting all their receipts in dollars, that they were building up all these very big reserves of dollar. And they decided that they didn't want to do that, and they wanted to have some of it in the form of their own currency. So they've been pushing their exporters and importers to use the yuan as a currency in which transactions happen. It's still a very small share. The dollar is still by far the big currency that gets used in world trade. So I think it's fine. I mean, one could step back and ask, should India be doing something similar? Should India also be trying to push for the rupee to be an international currency? At this point, given the things that need to be fixed, I think that seems to be the least important of the many policy issues that one has to fix. Oh, you asked about the GST and the bankruptcy bill. Yes. So the GFC is a big deal. I think it's a big deal. I mean, regardless of what you say about what the impact is going to be on growth, the fact that you can have one common market in India is a big thing. I mean, if you can do that with 19 nations or 17 nations in the euro area, you really should be doing this. I mean, India should have one common market. That I think the GST is a big deal. But there are lots of issues with it. They're trying to do bankruptcy reform too. Now, getting these bills passed is obviously turning out to be a big challenge. But these are very important issues.
The lion's share of its profits comes from US and Euro. And with Euro crisis, how do you think it would impact on India? And if so, how could it be mitigated in order to save the risk of losing out of a lot because of the Euro crisis?
If there is a serious Euro crisis, India will be negatively impacted by that. I mean, there is no quick way of managing to raise income from other parts of the world. Just like every other country, a major Euro crisis is going to have a big economy as a whole within their own country. And so I think as long as it's not relying entirely on world demand, but relying also on domestic demand, and if India is going to be one of those few countries that are growing at 7 or 8%, then it should get some insulation from the fact that it can switch from external demand to domestic demand. And of course, the U.S. economy is on an upward trend, but if there's a Euro crisis, that's going to have an important effect on the U.S. economy too. And so the world economy as a whole will slow down at that point in time, and then there will be some negative repercussions. But that's part of life. I mean, that's what business cycles are. There will be ups and downs.
I didn't have macro yet, so I was a bit silent, hesitating to ask any question. So you were talking about the distribution network has to be fixed for the agriculture sector to grow from the bottom level, I mean from the farmers level, and to GDP to increase. So what do you think from government perspective the policy should be? Because they have already created bazaars, mandis many years back to fix this part of distribution network. But that had been compounded in these years, like that distribution network issue has increased because of these mandis. So what do you think government should do as part of the policies?
Okay, great. This is somebody else mentioned that there's a lot of cartelization in the distribution network, and breaking those cartels have turned out to be very hard to do. So the question is whether you can use technology as a way to basically supersede the existing network that you have. Of course, there's always going to be lots of forces that would want to prevent that. But I think that this government, when you hear it talk, there is discussion about using technology as a way so that farmers see the prices of world prices much more easily. You can, maybe have an exchange where it's not the case that farmers actually have to show up in the mandi and decide, because some of the problem, as you know, in microeconomics is the so-called hold-up problem, which is the fact that you bring your produce to the market, and the buyer basically says, okay, I'm just going to wait, and your product is perishable, which means you really then have every incentive to sell it at whatever price you can. So if they can fix those issues, using technology, I mean, that would be my hope. It was a very, very good question. I also should tell you that, I mean, this is no slight to the men in this audience, but I think women always think of, why they might not be in a position to ask the question. You started off by saying we did micro and not macro. I don't think that would have bothered any of the men in this audience that they did micro and not macro, and it shouldn't bother you either. But anyway, good luck.